Today's number is 100, and the reason it's pretty simple. It looks like we've just seen massive rotation across the board, and it's all thanks to one man, Jerome Powell, and his Jackson Hole speech. Yes, he's pretty much said that there may be a cut in September and maybe more to come, and the market has taken that as absolute rocket fuel. So with Nvidia earnings coming this week, guys, and one of the biggest sells ever over 17 years when it comes to hedges on oil, what exactly is going on in a massive week? Today, we'll take a look at stocks, commodities, and cryptos in the special weekend edition. Don't go anywhere. There are some stats here that you need to know about. See you soon. Well, welcome back everybody to the special weekend edition of The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. And boy, oh boy, was it a green session. Rotation went wild, as we suspected it may moving forward. And Jerome Powell, of course, had everything to do with this because he basically opened the Fed to doing multiple cuts. Let's talk about exactly what went down, why it matters for us as investors and traders, and how it usually plays out. Could we still be going down the recessionary line, or are we going to go into a massive bull euphoria run? Let's take a look firstly at the speech itself, but the big thing here were, of course, these comments. Putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside, and risks to employment are to the downside, and this is a challenging situation. Remember, the Fed is dual mandated, and they're meant to be kind of balancing both of them whenever they can. The main thing here, though, was from the end. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balances of risks may warrant adjusting our policy stance. As soon as that happened, guess what? The market went ballistic because it opened the door for rate cuts. And not just one, a policy stance mandate change that could lead into way more rate cuts, which we know, of course, Trump wants. Now, what is this going to do? Well, it could send a temporary rocket ship underneath the markets, but it could also end in very bad markets. Have you ever heard of stagflation? That could be something that happens. By the way, we do like gold on this channel, and it has been doing all right for the last couple of years. But let's quickly play out here some of the things. Now, this is courtesy of Mike Zaccardi, a Bank of America review here. And basically, it showed that Powell's Jackson Hole speech here was more dovish than expected, emphasizing shifts risks towards the labor market. And the key line was the outlook and shifting risks may warrant adjusting policy, driven by payroll revisions rather than new inflation progress. So effectively, they've made a decision. We'll deal with the jobs. We will not be dealing with the inflation concerns caused by tariffs and other things in the future. And if you've been watching our channel for a while, guys, you would know that just 2 weeks ago, we opened up that very interesting report from Goldman Sachs that said, but come October this year, we're going to see most suppliers passing on the tariffs. Then we've also seen those problems with, of course, Walmart already saying that they're going to up fruit, vegetables, everything else. It's going to be a wild time in markets over the next couple of years. Balancing the big thing here, which is going to be the AI earnings and the massive boom there from the stock market and what's really happening in the economy. So how did the betting markets take this? Well, that tends to be the one we use more so than the economists nowadays. And you can see it here, the Fed decision in September has now gone to a 77% chance of a 25 basis point cut. And I might expect that to actually go up a little bit. So maybe be 80-20 by the time we start just next week. Now, why is this so important? Well, of course, it happens as inflation actually starts to pick back up again. And you can see here inflation versus the Fed's expectations, or Fed's funds in this case, is actually picking up even though we're in this kind of stable baseline for the last little while. Now, how is this going to play out? Well, the problem really becomes nobody quite knows the answer to that. But if I had to guess, I would say that there is a higher chance that inflation actually starts to go up, and there is a lower chance that we actually deal with inflation while cutting rates. But it'll all come back down to, realistically, how fast all of this stuff happens. Now, the labor market is also starting to soften a little bit, and that is the main concern. Basically, the Fed said, don't worry about the 2% inflation target. We're done with that one. Now let's talk about the labor market and deal with the real problem here, because, of course, we're seeing a softening thanks to AI and also just a cooling economy in general. And they do say sometimes the best bull markets are during these kind of soft or lethargic or anemic style markets because they need support from policy. Usually it's either Fed policy or it's government policy. And we've argued for a little while that we've got government policy, and now it looks like we've potentially got Fed policy. So don't think that necessarily it means the market's going to crash 25% tomorrow or anything like that. It's more likely than not we're seeing a broadening pattern here into rotation, but still possibility of a pullback in this Q3, and I'll explain why soon. Latest report here from Goldman Sachs also shows that they believe the US economy is continuing to expand. And that's great. On the surface of it, you think, okay, fantastic. It looks like we're going to have a great GDP number. But the problem, guys, is that this GDP number is coming from basically AI. And AI is now leading into most of the gains here that we're seeing in the economy themselves. So if we do get a Fed cut, if we do start to see the market continue to rotate down this line, which sectors do best? Well, as you guys know, it does tend to hit into certain areas, and those are usually ones that don't make any money. So what did the best on Friday? Well, of course, was the Russell 2000. And you guys know that 40% plus of the businesses, it turns out, in the Russell 2000 don't make any money. So in the end, what does that do? Lowering their cost of borrowing ups their overall ratios. So that's, of course, what we saw happen. We actually take a look at the last 5 days as well. You'll see what we've been discussing, which is that rotation has been occurring, has happened. But it was really the Friday session that I thought was most interesting because we got a couple of big movement breakouts. Number one, most notable, was actually oil services. And we also saw energy do very well. And both of these, as you'll find out soon, have a very interesting kind of situation because oil is now heavily underhedged by the hedge funds. And it's the first time that's happened in 17 years. So it's been quite a while. So should we really be cutting into this? Well, some people argue like this chart here that we probably shouldn't be. But hey, you can't fight it. I can't fight it. No one can actually make a decision what the Fed's going to do. So we have to instead go to how does the market end up reacting? Now, it turns out that when you get a cut near all-time highs or at all-time highs, that is notoriously bullish for markets, which you'll see in a moment. But it can also be the beginning of something very bad. And it all comes back down to structure. In fact, the next kind of 1 to 3 months, similar to what we did last year in 2024, will really make or break whether this market is going down the recessionary line or whether it's going up to kind of a general bullish style market. And remember, it's the way the market actually reacts that will be key. It's not the initial possibility of a dip that happens generally in the full sample median. So we actually sometimes do see that. However, generally speaking, we will make a decision over the next 3 months in particular to market structure. And the reason why is because this what happens first off. We tend to see the Fed make a cut. The market can sometimes dip on that, surprisingly, and then it starts to rally up through. And you'll notice that if you have a look here at the 1 month stat, it's a little bit worse than, of course, the 2 month and 3 month stats themselves. Here's the latest data from Ryan Detrick over at Carson Research. And you can see here that next month after a cut, so this would be September, we are 50-50 in terms of gains and losses. Then we go to 77%, and then we go to 100% by the end of the next 12 months. So this is a pretty big, crazy statistic. And so far, it's been coming true, of course, when you take a look at how it played out in 2024. So guys, how then should we be looking at this market? Well, most people are calling it a bubble, and that's fair. You know, when you start to get the word bubble come in, you have to say, okay, is it a bubble? I would say yes. Some of you would say no. I would say probably it is. But the thing is that when people mention the word bubble and everyone's saying that, it usually means not everybody is in. So it's why we've argued for a little while that we might see a Q3 sell-off at some point, little dip, and then probably see some form of extension on the markets. And maybe this extension will start here and continue on. I would still say there's probably going to be a little bit of shenanigans going on in Q3, and we'll see why. But there's one thing for sure is that Wall Street is incredibly bullish on tech. And you can see why. Tech versus the rest of the market. Have a look at the normal parts of the market. They're doing okay. Have a look at tech. It's going ballistic. And this is because, of course, they're able to fire people. They're able to do all sorts of things thanks to AI and what they're actually moving through. And it always brings up the argument of, are we in a 2000 style bubble or are we in something different? Well, it's definitely different, but it has many similarities. You can see here, the big thing is that today we actually have a overall kind of stock market that has actually got real earnings, but there's massive leverage underneath it. In 2000 or 1999 to 2000 levels, we had a market that was not only leveraged, but it was leveraged on companies that made no money. And you could argue that some businesses that are currently being traded make no money and they're being traded a lot, but it's still a very interesting point. So let's take a look here at bullish oil bets because they're falling to 17-year lows. The last time we saw this was actually the end of the global financial crisis, and we saw a bit of a resurgence in, of course, oil placements. Now, the reason why oil could do okay is if the market starts to smell out the idea of stagflation. And if you know your details on stagflation, mainly commodities do well, oil can do okay, and we can see gold do quite well. But we don't generally see very good things happen to the equities markets long term if we do enter into stagflation. And that's the problem that Fed's playing with right now, doing these cuts into, of course, uncertain times. I'm sure Jerome Powell may not want to do it, or maybe he does, who knows. But the main thing is that that is pretty much the most likely situation that's going to happen now. Now, you can see here, according to Goldman Sachs, this puts them on their forecast. I just thought I'd update their forecast here. Their forecast is 6,900 over the next 12 months, which actually makes a bit of sense because we originally had 6,850, which I haven't really changed at this point. I think my aim was to get it at around October this year based on 12 months ago. And it's actually doing surprisingly well, considering I actually thought during the tariffs maybe we wouldn't be able to get there. But you can see here their end of year is 6,600. I would say with this market, the big thing here is when you're taking a look at it, you've got to think that there's still going to be shakeouts because the rest of the street isn't in. And it really doesn't change any of our baselines to what we've thought. You can see, according to Fundstrat, Macro Research, they believe the markets could be at 7,000 by the end of the year, which is, of course, an upgrade on where everyone was just during the tariff periods. And you can also see that there are problems underneath the hood. We recently did a video that showed us that we had bankruptcy filings by certain sectors going up. And this is not a good sign. You know, consumer discretionary, industrials, there are big issues here in the US economy, and we're not necessarily going to see them fix themselves. So remember, if we do end up going into stagflation, expect consumer discretionary in particular to get belted quite heavily. S&P 500 performance, again, we've looked through the Q3 data. This actually may play out. Remember, if we do get a September cut, sometimes what happens is the cut happens, kind of like a buy the rumor, sell the fact. So we may see some buy here. We buy the rumor, we sell the fact, and then we end up buying afterwards. Maybe we don't go down the recessionary line. The next 1 to 3 months is going to be super important. So make sure to subscribe to the channel if you're interested in that. So there's so much data in today's video because it was absolutely ballistic Friday, but I thought I had to give you even more, guys. So we've got even more to go through, but just remember, pre-Labor Day weekend, we generally do see an upside to the markets. Post-Labor, that tends to be where we sometimes get some negative markets. So this is some of the most notables here. This is, again, data we posted over on our X account. Links in the description down below. And you can see here there are a couple of exceptions. So, of course, there were a few strong rebounds. 2011 in particular did 5% post-Labor Day, but overall bias technically is downward into September. Because remember, September is the worst month of the year. Now, if we're having a look at where we are right now, we're literally around here, kind of climbing to around those same highs. Do we go down the normal line? Well, you could actually argue that things have been playing out relatively well this year. We saw the sell, which we expected to happen. We thought, of course, it'd be between 10 and 12, maybe 15%. It was more than that because of the tariffs. That was overdue. Then we've rallied since then, which is fine. We've ended up going to the third strongest rally of all time, which is pretty wild. And now, of course, we expect some softness in markets, even with this news. But what we've said recently, and we've talked about this together, guys, is we've talked about the idea of rotation. And rotation started up, in my opinion, around 2 weeks ago in the markets. And funnily enough, all of a sudden goes ballistic as soon as we get this data. So it's clear that the market was pretty smart. Now, why could it still be choppy? Remember, year threes of bull markets can do this. And of course, we also could still be in some form of high volatility for something like crypto coming into September. Now, the good news for crypto fans is that generally speaking, if we follow similar trends, you guys know we kind of have this bullish bias, at least at this stage, therefore, I guess the rest of the market as well, into December. And one of the reasons that happens is it's happened every other period of time, and we've generally got pullbacks at around these periods. So we did just see a 14% pullback on Ethereum. We saw a little bit less on, a little bit less on Bitcoin. And I'm not sure if we're going to see any more just yet, because of course, most people are now going to be playing this idea of stagflation, and that could really benefit gold, silver, and Bitcoin. So something to keep in the back of your mind. How often does the S&P 500 peak in August? The answer is not often. So of course, we don't really expect that to be the crash. If you're worried about a period of time, yeah, I mean, if you're looking statistically, you'd be generally worried at December. Now, we mentioned this week is big, and the main reason is, of course, because of Nvidia. Now, Nvidia is coming out Wednesday, guys. It's the most important stock in the market. It is the lead of the market. It is everything to the market. So, of course, we will be seeing this one. Now, it could be between 7 and 8% in terms of the volatility on this stock. And when you're considering the biggest stock in the world at the moment, that is going to be some wild action. So do remember, it's going to move hundreds of billions of dollars, and it is happening on Wednesday after the close. Do we expect it to be good earnings? Yes. Will it beat expectations? Possibly. The question is that still enough for the market, or is it a catalyst? So that's your main catalyst for this week, and something we will be paying close attention to. So let's take a look now at what happened on the S&P 500. It bounced off the daily 20 moving average, closing around here. We saw the advanced decline line go ballistically up. We had about 90% of stocks going up. And there are some stats around that we'll share in our next video. And you can see here that, of course, the market never really changed trend. For the bears, 6,200 remains the key level. And we went from being kind of more in a negative gamma during the session to, of course, a positive gamma. So let's take a look at the futures market. And you guys can see here pretty clearly that the market rallied up fairly heavily on the session, so continues to be in the bull run at this stage. The key levels for the Monday, of course, are these two. 6,500 is now going to become the focus, and the main reason is why is everyone started stacking calls around 6,480, 6,500. So the market didn't go fully positive gamma just yet, but if it does go through those levels, you can see the clear wall at 6,500. And of course, from 65, the next level that becomes clear is most likely 6,700 or 6,600. So it's going to be those two major levels that will then be looked at. In terms of the puts, you can see people were stacking ahead of the Jerome Powell speech, and we're looking at around 6,450. So that's going to be the main level that we are watching at this stage. Let's now take a look at Nvidia. It clearly put on a little bit, but this week will be all about breaking 185 after earnings if it can. If it goes past 185, 200 may be the next target for that particular stock. And Tesla had a good rebound, still in that kind of positive formation at this stage. 350 and 380 remain the main two key call option levels. Let's now look at the lead indicators. What did things do? Well, we saw a weakness in, of course, the tech sector from software side. It did rebound, but it wasn't really the sector of interest. The main thing was that we saw momentum slow down about this period here, which was the date of 13th of August. And we speculated that that was probably the beginning of Wall Street moving into other sectors. And you can see here, it was not a good day for the top 10 stocks in comparison to how well they've been doing. The equal weight technology sector did bounce up and protect itself from the head and shoulders, horror show kind of style market chart. And as we mentioned, these wicks were the most important levels to see broken out, and they did not. But it was really about everything else in the market. Value, the Russell 2000, which we'll look at later, and of course the big one, which was also the equal weight across the board. A new all-time high was hit by this. So it was more a movement here of Wall Street saying, okay, let's now go buy a bunch of other stocks and move into those. And they'd already been building the position earlier. And as you guys know, the big thing about our channel, and hopefully where you find value in it, is the fact that we look for things before they actually do happen instead of just commentating on the fact that they are happening. And the big thing here is that it was clear to see there was some rotational shift starting to occur. One of the next sectors is going to be, will we see a movement here in energy? Because energy has been doing nothing for ages. So this will be an interesting sector to watch over the next couple of weeks. So the market starts smelling out the idea of stagflation. That could be a bit of a concern. Let's have a look now at bonds. You can see here bonds market not showing anything changing going on, but we'll update that if we do see bonds risk. And the dollar prepped itself for a potential long, and then of course got crushed straight on Jerome Powell, because of course he said basically we're going to do a cut that's instantly going to lower the dollar. So no significant moves in the dollar in terms of changing trend or anything, but it did fall down. Now it was good for gold because it got just onto that 33.75 level. If we do see gold break out 34.50, guys, that's going to be a key zone. And it looks like gold, of course, has done a shift here. Silver, I wasn't sad about this one. I think most of you guys probably weren't either. 1.97% on silver, not bad at all. New high, not new high, but certainly a new high for the last couple of weeks. And that signifies a new hopeful test of 39.50. And as we mentioned in today's video, could it be that we're actually seeing a market that could go stagflationary, and then we have like the Bitcoin, gold, silver trajectory? So this is, of course, something we've been looking for on the macro side. I'd still like to see silver at 42, 43 in the future, and that's not that far off. So hopefully that can happen. Let's now go to the broad-based market. Semiconductors, of course, holding its trend last week and not falling through. It was a big day Friday. It could have been bad for it. And then, of course, Nvidia, you can see here, losing the daily 20, so no doubt losing some strength, but it's going to be all about the earnings. So it didn't lose full structure. It did certainly lose the daily 20, so it's now in a holding pattern, and we're sitting between 185 and 170. So we're trapped within those zones in options as well. When we break out, we're going to see probably a largish move. We've been coiling now for almost a month and a half, 2 months on that stock. Let's now go to Tesla. Big strong candle, similar to the rest of the market. 350 is the first target, 380 for the second target. So let's see whether that continues on. It's going to be interesting because when you look at the crypto market at the moment, some of the exuberance has come off. Intel was another one that got an announcement from, of course, Trump. And then we've seen tariff discussions as well over the weekend. But I think we can leave those until another video. One of our favorite moves as well recently, which has been China, went ballistic. Another 1.45% up. And this thing has just put gain on gain on gain on gain on gain for basically 2 months. So it's been very, very strong. And that's a sense of liquidity coming back into the market. We've talked about that quite a few times. Now let's have a look at the NASDAQ. You can see here the NASDAQ itself was underneath this rudimentary trend line. It did start to put pressure on. It was almost down there at the 22,700. But remember, it is still a series of higher highs and higher lows. Until that changes, technically the fund flow is still positive. Let's now have a look at although I still think there's going to be a Q3 shenanigans, but let's have a look here at the US 2K. Now, it looks like that's going to be trying to go for that all-time high, 2430 kind of area. And we did see the tweezers set up into Jerome Powell, and it was a massive day, 3.9%. Anything that didn't make money, it was having a great session on pretty much on Friday, which is kind of almost ridiculous when you think about it. Ethereum, it was a massive one as well. I'll just show you here the percentages, 15%, one candle. So that's the cryptoverse. And it really liked, obviously, this risk on across the board, and it pressured a new all-time high. So that's, of course, a big deal here. Ethereum, was that all we got in terms of the shallow pullback? I would have preferred maybe down here at the 3600s, but of course, we are still bullish into cryptos into at least December this year. And you can see here, Bitcoin had that real test of 112. Now, if it had dropped 112 and closed below, I actually think it might have gone about 106, 105, but the market did recover back up. It broke this little temporary downward trend line, and this, I guess, opens up more day traders to try to buy and look for stop losses below and all sorts of things. Time will tell, but I think clearly the market is feeling like it can push and squeeze people a little bit more after that Jackson Hole situation. And at this stage, Bitcoin, of course, did break up on the small time frames. On the daily and weekly, daily was okay. Weekly was just a weak rejection, which you can see here. For the week ahead, guys, there's a bit of information coming out, but the main thing is Wednesday, which is, of course, Nvidia, and that's going to be the big one. Prelim GDP as well, which is expected to be pretty decent for the US, driven mostly by AI. And then, of course, we get here core PCE on Friday. But maybe the big news is really what happens the week after, because we've got the Nvidia earnings, sure, but then we get that bank holiday, and that's where sometimes things do kick off. So something to watch out for, guys. Some massive structure changes that could happen over the next 1 to 3 months, and make sure to stay tuned to FX Evolution if you enjoy the content that we do create. Follow us over on X, follow me on LinkedIn if you're interested. I do post there quite regularly at the moment, like 5 times a week. So there's lots going on, and these markets are never dull. One thing's for sure, though, is I expect it to be quite volatile over the next couple of months. And do remember that stat, even with cuts that happen at all-time highs, it's a 50-50 coin flip, and we are still in year 3 of a bull market and post-election year. This is when the real volatility can happen. Guys, have a great weekend, and I'll see you during the Monday live stream. Bye for now.